There are people in this country earning $150,000 per year who are one paycheck away from financial collapse. Not people who made bad investments. Not people who went through medical emergencies. Just people who earn a lot and somehow have nothing. The phenomenon has a name: high-income poverty. And the mechanisms that create it are specific, identifiable, and almost completely invisible to the people trapped inside them. This video is for anyone who has ever wondered why their income keeps going up but their financial security doesn't follow. Because the answer isn't that you're spending on the wrong things. It's that you're caught inside a system designed to extract every dollar you make, and it targets high earners more aggressively than anyone else. Let's start with the number that should anchor this conversation. In the US, research consistently shows that approximately 60% of workers earning between $100,000 and $149,000 per year are living paycheck to paycheck. 60%. Not because they can't afford to save, they technically can, but because their spending has expanded to absorb every dollar of income growth. This is called the income spending elasticity problem. As income rises, perceived needs rise with it. The lifestyle reference point shifts. The neighborhood you moved into when you got the first raise has a social spending baseline. The car you drive when you're earning $120,000 is different from the car that made sense at $60,000. The vacation your peer group takes requires a different budget. Each income increase brings new baseline expectations, from yourself and from the people around you. Let's trace exactly how this happens. You earn $60,000 per year. You rent a $1,200 apartment, drive a used car with a $250 payment, and occasionally eat out. Life is tight but manageable. You save a little. Promotion. You're now earning $90,000. You move to a $1,800 apartment. It makes sense, you can afford it. You trade up to a $450 car payment. You start eating out more frequently because you've earned it. Subscriptions accumulate. Your wardrobe gets upgraded for the professional environment you're now in. Each decision is individually reasonable. Collectively, you're spending $2,000 more per month and saving $500 less because you're also in a higher tax bracket. Another raise, $120,000. You buy a home. The mortgage, property taxes, insurance, and maintenance now cost you $3,200 per month instead of $1,800 in rent. You buy new furniture because the old furniture doesn't fit the new house. The car gets replaced because it needs expensive repairs, and it doesn't make sense to fix a $12,000 car when I can afford a $35,000 one. The home needs landscaping, a security system, a lawnmower, tools for basic maintenance. Each step is logical in isolation. The aggregate is a lifestyle that requires your current income to sustain, not a lifestyle that leaves room for the income to build wealth. Most people make the lifestyle decisions against their gross income. This is where the math quietly breaks down. Going from $60,000 to $90,000 feels like a $30,000 raise. In practice, the take-home pay increase is approximately $17,400 because taxes take a larger bite at the higher bracket, and FICA continues without a corresponding reduction. The actual monthly take-home increase is around $1,450, but the apartment upgrade costs $600 per month more. The car upgrade costs $200 per month more. The additional dining and social spending runs $400 per month more. That's $1,200 per month in new fixed and semi-fixed expenses against a $1,450 take-home increase. The raise generated $250 per month of actual financial slack, and most people don't even track it closely enough to notice. They felt a $30,000 raise and acted accordingly. Their bank account received $17,400 of it. It's worth naming which professions show up most consistently in the research on high-income financial stress, because the pattern is not random. Physicians are statistically among the most financially vulnerable high earners in America. The average medical school graduate carries $250,000 in student debt at graduation and enters their career at age 28 to 30, a decade later than peers who went directly into the workforce. By the time residency and fellowship end at 32 or 33, the physician has spent a decade building a mental image of the doctor lifestyle they've been deferring. They buy the house, the car, and the wardrobe simultaneously, often at the exact moment they're also beginning to pay down six-figure student debt. Lawyers face nearly identical dynamics. Corporate executives experience the social spending pressure embedded in their professional relationships, the unspoken expectation that you dine, travel, and entertain at the level of your income. High-earning real estate agents and salespeople carry the additional danger of income variability. They build a fixed expense lifestyle on peak year earnings, then find that lifestyle catastrophically unaffordable in a slow year. In every case, the social environment of the profession creates constant comparison pressure calibrated to gross income, not take-home pay. Here's the trap's mechanics. First, fixed expenses expand with income and then don't compress when income drops. Mortgage, car payments, insurance, subscriptions. These are sticky. When your income was $60,000, you had no mortgage. If you take a pay cut or lose a job at $120,000, your fixed expenses don't adjust with you. You can't easily downsize the mortgage. You can't easily return the car. The fixed expense structure you built at $120,000 requires $120,000 to survive. And you have no cushion because you were spending $119,500 of it. There is also a specific trap that hits dual-income households hard, and it's one of the most common and least discussed versions of this problem. Two household incomes of $85,000 each produce $170,000 gross household income. The spending decisions of a dual-income household at $170,000 commonly include a $600,000 home because, together we can afford it, two financed newer vehicles, significant childcare costs, substantial dining and entertainment spending, and higher-tier vacations because each partner has been working hard and deserves it. Each individual decision is defensible on the combined income. But the fixed expense structure built on that combined income requires both incomes to operate. If one partner loses their job, takes a medical leave, or wants to reduce hours for a child, the entire financial structure becomes untenable. The couple who earns $120,000 and spends $60,000 can survive any of those events. The couple who earns $170,000 and spends $165,000 has built a financial house of cards out of two perfectly good incomes. Second, social spending escalates at higher income levels. The people around you when you earn $120,000 are different from the people around you at $60,000. Restaurant choices, vacation destinations, gift giving at the holidays, the implicit social contract of a higher income peer group, these are real and often unconscious spending escalators. Keeping up is not a vanity, it feels like a professional and social necessity. Showing up to the company dinner at a mediocre restaurant when your colleagues go to the nice one carries social costs that feel very real. Third, high earners pay disproportionately high rates on consumption taxes. Sales taxes, property taxes, taxes on investment income, state income taxes. As income rises, the absolute dollar amount paid in taxes rises dramatically. A household earning $120,000 may pay an effective federal rate of 18 to 22%, plus state taxes, plus FICA, reducing take-home pay to $85,000 to $90,000. When your brain says, I earn $120,000, but your checking account receives $7,200 per month, the spending decisions happen against the $120,000 number, and the bills get paid with the $7,200. This gap is where the trap hides. Fourth, the opportunity cost of delayed investing at high income. Every year you spend 95% of $120,000 instead of investing a meaningful portion is not just a year of low savings, it's a year of foregone compounding. At a 10% annual return, $20,000 invested at age 30 becomes $349,000 by age 65. The same $20,000 invested at age 40 becomes $135,000 by 65. The high-income poverty trap doesn't just keep you poor in the short term, it compresses your retirement wealth by delaying the compounding clock. So how do people escape it? The most rigorously tested escape mechanism in the behavioral finance literature is the Save the Raise commitment, a pre-commitment device where the investor decides in advance to direct the full after-tax amount of any raise or bonus to investment for the first 12 months before allowing any lifestyle adjustment. The key word is pre-commitment. Research on Save the Raise programs embedded in workplace 401k plans shows that when HR contacts an employee at the moment of their performance review and facilitates an immediate contribution increase, that same day, in the same conversation, the participation rate runs between 62 and 78%. When employees have to initiate the contribution increase themselves later, participation drops to 8 to 12%. The timing is everything. The raise feels most like new money in the exact moment it is announced. That is the moment to redirect it before lifestyle decisions absorb it. One conversation at the right moment is worth a year of trying to manually save from a spending account that is already adjusted to the higher income. The first escape is the savings rate commitment made before lifestyle inflation has a chance to attach. The most effective tool known in behavioral finance for preventing high-income poverty is the pre-commitment device. The moment you receive a raise, commit a specific percentage of the increase to automatic investment before you make a single lifestyle change. You increase your 401k contribution percentage before you sign a new lease. You set up the automatic IRA contribution before you start shopping for a car upgrade. If you pre-commit 50% of every raise to savings, your lifestyle still improves with every income increase. You're just improving it more slowly than your earnings grow. The gap between earnings and spending is where wealth lives. The second escape is regularly calculating your savings rate, not your income. Your income number is meaningless for wealth building. Your savings rate, the percentage of gross income that goes into investment or savings, is everything. A household earning $70,000 and saving 20% is building more wealth than a household earning $140,000 and saving 5%. The math is unambiguous. $70,000 at a 20% savings rate is $14,000 per year going into investments. $140,000 at a 5% savings rate is $7,000 per year. The lower earner builds twice as much actual wealth because the rate is right. Income is a ceiling. Your savings rate is the door. Get the savings rate to 15% minimum before optimizing anything else. At 15%, time and compounding do the work. Below 10%, you are perpetually dependent on your income and one job loss from financial crisis. The specific target to aim for, at a 15% savings rate starting at age 30, a household earning $100,000 should accumulate enough to retire at a comparable standard of living by their mid-60s without relying on Social Security as their primary income source. Drop the savings rate to 5% and that same household will need Social Security to be the majority of their retirement income, which means they are dependent on government policy decisions for their financial survival in retirement. The savings rate is not a number, it's a proxy for your independence. The third escape is an honest accounting of fixed expenses versus discretionary spending. Pull up your bank statements for the last 3 months. Identify every fixed expense: housing, insurance, loan payments, subscriptions. Add them up, divide by your monthly take-home pay. If fixed expenses exceed 60% of take-home, you are vulnerable. Any income disruption will require immediate lifestyle compression, which is psychologically brutal and financially damaging. The goal: keep fixed expenses under 50% of take-home. That 10% gap between 60% and 50% is the breathing room that separates financial vulnerability from financial security. One concrete number to carry out of this video: your fixed expenses, housing, vehicle payments, insurance, minimum debt payments, subscriptions, should not exceed 50% of your monthly take-home pay. That is the threshold. Above 50%, you are financially fragile regardless of your income. Any disruption, a job loss, a health crisis, an economic slowdown in your industry, requires painful, immediate compression of a lifestyle that was built to require your full income. Below 50%, you have the breathing room to absorb shocks, build wealth, and make career choices based on what you actually want rather than what your fixed expense structure demands. High-income poverty is quiet. It looks like success from the outside: the nice apartment, the car, the vacations on social media. It feels like success too, right up until it doesn't. The doctor, the lawyer, the senior corporate manager who never built a financial cushion because every raise got absorbed into the next lifestyle tier. These people are not rare. They are shockingly common. The difference between them and the people who build actual wealth at high incomes is not luck. It's the commitment to letting the gap between income and spending compound, instead of letting the lifestyle expand to fill it. What's your savings rate right now? No judgment, just honest. Drop it in the comments. And subscribe, because next week we're covering the 8 wealth rules that wealthy people obsess over, the ones that you're probably ignoring completely.